Yeah. Okay, let's get started. So, yeah, you know the basic smart money concepts, right? The basics like what order blocks are, what liquidity is, imbalances, and all of that stuff. Yeah.
Yeah.
Hope you know that. Yeah. So let's start with this now. Now, do you know about the protected highs and the lows, or is the strong highs and lows? Okay, so let me show you. Something like this is what we call a strong high. Okay, something like this is what we call a strong high. So what you want to see is liquidity being taken out and structure getting broken. So once this happens, we say that this high right here is a strong high. Now I'll show you this will be something very important when we mark out ranges and all of that. Okay, so that's a strong high, and same way, this right here will be a strong low or else a protected low. So what we want to see is liquidity being taken out from a previous low and then structure being broken. So once this happens, this will be a strong low. Okay, now another thing is now when I say liquidity has to be taken out, okay, when I say liquidity has to be taken out, it doesn't have to be like now most people would assume liquidity is equal highs, right? Yeah, this is liquidity, or else maybe trend lines. Okay, yeah, this could also be liquid, but it doesn't have to be this all the time because do you know the three candle formation for a swing high and a swing low? Yeah, the three
I'd
candle
like you to
formation.
go.
Let me
Yeah,
show
I'd
you.
like you to go through it again, please. The streak
Yeah,
and the
let me show you.
formation. Yes,
Yeah, let
please.
me show you.
Thank
Okay,
you.
so when I say a swing high, what we want to see now, it's just any three candles. Okay, it's any three candles. So what we want to see is, let me show you a clear example. Yeah, something like this. Something like this is what we want to see. Like let's say we pick these three candles. So what we want to see is a lower high to the left, a lower high to the right, and
Yeah.
the middle candle will turn into your swing high. Okay, the middle candle will be your swing high. So see, even this right here is a swing high. Why? We have a lower high to the left, a lower high to the right. So this will be a swing high. Okay, that little wick right here will be a swing high. See, even this is a swing high, a lower high to the left,
Sorry,
lower high to the
Udara.
right.
Udara.
Yeah,
The
yeah.
previous one you just mentioned now. Can
This
you
one.
show me? Yeah, this one. Yeah.
Okay.
Where's the lower one
Yeah,
to the left?
let me show you. See this? Lower high
Okay.
to the left, a lower high to the right. Just three candles. Okay, we're only
Oh,
choosing
okay.
three candles. One, this one, and then this one.
Okay.
Okay, so if we pick these three candles, we can see that this one is higher than the both of them, right? Higher than the left one and higher than the right one. So which means this will turn into a swing high. Simple. Okay, so it's nothing to overthink. It's something very simple, but it's very important because above every single swing high in the market, there will be buy stops resting. Okay, there will be buy stops resting above every single swing high in the market. Okay, so breakout traders will be placing their buy stops above these swing highs. Okay, so let's talk about that later. And yeah, same thing, like what's the swing low? Okay, what's the swing low? A three candle formation. Let's see a clear example. Let's see a nice one. Where do we have clear ones? Yeah, in all these areas, we do have swing lows. I'm trying to show you a clear one that way you'll understand it better.
Okay.
Um, let's see. Where do we have it? Yeah, here we go. A very perfect example. This is what we call a swing low. Okay, so what we want to see is now in this case, the opposite of what we talked about earlier. A
Yeah.
higher low to the left, a higher low to the right, and the middle candle will turn into your swing low. Okay, the middle candle will turn into your swing low. So this right here is what we call a swing low. Now, once again, this formation is also important because this is where the breakout traders place their sell stops at. Okay, so below every single swing low in the market, there will be sell stops resting. Like look at this, for example. What did this wick do? Okay, what did this wick do? Cleared out sell stops.
Yeah.
See that? So what they did was they took out all of the sell stops that were resting below these lows, and then they went in the opposite direction. Okay, they go in the opposite direction. So that's what they do all the time, from buy stops to sell stops. You know, after taking out this low right here, where will they go next? After taking out sell stops, always go into buy
But
stops.
yeah.
Yeah. So they take that out and then they give you another pullback. Okay. So now when I say liquidity has to be taken out, okay, when I say liquidity has to be taken out, all we want to see is a run above a swing high and a break of a swing low. Okay, a break of a swing low. Now remember, for this liquidity grab, for this top hunt, like we don't care if it happened with a wick, with a body or whatever, but this break right here must happen with a body closing. Okay, we're not going to consider wick breaks to be a breakout structure. It has to always be with a body. Okay, a body has to close below these lows. Only then we will consider this as a breakout structure. Okay, only then it would be a breakout structure. So same thing in here. It has to run below a swing low
Yeah.
and give you a break of a swing high. Okay, a candle closing. So that is what we call a strong high and a strong low. I'll show you examples later. Yeah,
Sorry, Udara. To
yeah.
buttress what you've just said now. Now,
Okay,
if I've got an example, for example, in GU today,
Okay.
If I look at my chart, due today on the 29th, I think in London time around 3:30.
Okay.
Or is it around 5?
What time frame was it? Yeah. Okay. What time frame was it?
You can check M15 or M30.
Okay. Yeah.
Yeah, there was a weak break. But on the line charts, it shows like it's a break of structure, a bullish break of
Yeah,
structure.
now I'll show you. Okay, we'll be using the line chart more now. Okay, we'll be using the line chart more. That's why I see. That's why I have it marked. We have it in here. Okay, so we'll be using the line chart more. But don't worry, like we're not gonna get trapped with all of these moves because I'll show you once we go into ranges and all of that, you'll understand like what they're doing in these areas. Okay, you will understand what they're doing. But yeah, like days like this, I prefer staying out of the market because nothing was clear. No setups. So if there are no setups, we can't force anything, right? We cannot force anything. Okay, so if the setup isn't clear, like if the coast is not clear, we must learn to stay out. Okay, so I'll show you, I'll talk about those stuff later, but let's go through the theoretical stuff first. Okay, so this is what we call a strong high and a strong low. Now, yeah, now you might have seen how these inducement patterns and all of those stuff works, right? So let's say we had a stop hunt, a breakout structure, and then the market might give you a little retracement, and let's say we got another break like this. So now if you just look at basic market structure, what do we have? We have a high, right? We have, and then we got this lower low, right? A lower high and another lower low down here. So now this is just basic market structure. So we know that if price is creating lower highs and lower lows, it's bearish, right? It is bearish.
Yeah.
So now if someone wants to re-enter, what will they expect? Anyone would expect another lower high and a lower low, right? So they'll be expecting maybe a lower high or something to form in these areas. So what will smart money traders do? Smart money traders will start marking out order blocks in these areas, right? They start marking out order blocks here. Like some of them will right away set their limits here, stop loss above that, and they'll target lower prices. Okay, so some people would do this. Some people will wait until price gets inside of this, maybe wait for a lower time frame break and then enter. Okay, they will also do that. But yeah, now not only smart money traders are doing this, right? Who else? We have the supply and demand traders, right? Supply and demand traders might tell you that this is supply that broke the structure. Okay, the supply that broke structure, or it's maybe a rally, base, and a drop, right? So supply and demand traders will also set their limits here, maybe with their stop loss above that high. Okay, but not only smart money and supply demand, who else do we have? We have the trend line traders, right? Now, what are the trend line traders doing? Okay, they are also expecting pretty much the same thing, a retracement back into the trend line and then the drop. Okay, so this is what they are expecting. So once it gets back into the trend line, they'll sell it with their stop loss above the previous touch into the trend line, and they'll target lower prices. Okay, so that is what the trend line traders would do. Now, not only trend lines, what is this? Break and retest, right? Break and retest. So what will they do? Maybe wait for that bearish engulfing candle to form, use that as a confirmation, sell it, stop loss above that high. Okay, so that is what the break and retest traders would do. Not only break and retest, this right here is what we call a flip zone, right? Because a broken support will turn into resistance. Okay, a broken support will turn into resistance. So maybe they'll also wait for that bearish engulfing candle to form. And once that forms, they'll sell it with a stop loss above that high. Okay, and then finally, since this high right here is a swing high, what do we have above that high? Buy stops, right? We have buy stops. Yeah, we have a pool of liquidity resting above that high. Now, now if you know ICT, yeah, you might obviously. So ICT tells you that liquidity is something like a magnet. Okay, liquidity is something like a magnet. So let's say like this. Okay, this is a magnet. And then price. Okay, what is that? Price is like a paperclip. Okay, price is like a paperclip. What happens? It always draws towards the magnet, right?
Yeah.
It always draws towards the magnet. This is what we know. So we have to always know where the draw on liquidity is. Okay, we have to always know where the draw on liquidity is. So now in this bit of price action, where is the most amount of liquidity? Is right above that high, right?
Yeah.
Right above that high. So now as smart money traders, if we do something like this, what are we doing? We're doing the same thing as a retail trader. Yeah, we are retail traders, but we're not using those concepts, right? But if we do this, we're placing the stop loss at the same area where they would place their stop loss at, because now see, they're entering from a trend line, we're just entering from an order block. So the only difference is the strategy. Okay, nothing else. The stop loss is at the same place. Okay, so what we should first do is we must spot the liquidity. Okay, once we spot this liquidity, now we know that it is not safe for us to look for anything around here. So what we do is we look for something above that. Okay, we're going to look for something above that. Now remember, for this right here, okay, now this is the tricky part. Okay, this is the tricky part. So this could be an order block. Okay, this could be an order block. This could be a breaker block. Okay, so you know what breaker blocks are, right? Yeah, This could be a breaker block. I'll show you examples. And then this could be an imbalance, or else, most importantly, this could be a rejection block. Okay, this would be a rejection block. Now, let's put imbalances aside. Okay, let's put imbalances aside. We're not going to focus on that a lot. But remember, it's just one simple point of interest that we're looking at. What is that? That's the opening prices of the candles. Okay, simply, we're going to focus a lot on, actually, it's not the opening prices, it's the closing prices of the candles. Okay, so yeah, the closing price of the previous candle is the opening price of this candle, so it could be whatever.
Yeah, is it the closing or the opening?
Both of them. Like most of the time, I'll tell you the most probable thing to do is use the closing price. Okay, use the closing price of the previous candle. Let me show you. I'll show you examples. Okay, so yeah, this could be an order block, a breaker block, a rejection block, or it's an imbalance. So now if you put if you put imbalances aside, we're simply focusing on the closing prices of the candles. Okay, we're focusing on the closing prices of the candles. That is what we are focusing on. Okay, so yeah. So now let me show you. Now, and the next thing is now order blocks, breaker blocks, rejection block. It's the same thing. Okay, it is the same thing, but like, yeah, it's the same closing price, but once we switch time frames, you will get a different view of it. Okay, you're gonna get a different view of it. So let me show you. Now, first thing, yeah, let me show you. So yeah, now firstly, you know how order blocks are formed, right? You know how order blocks and breaker blocks are formed. So let's directly dive into it. Now, most people would think now, yeah, let's go through that quickly. Now, most people would assume that an order block is a candle, right? An order block is a zone. No, it's not that. Okay, an order block is a specific price level. So what is that price level? So let me show you. The first thing, let's say maybe we had liquidity, equal highs. Now, what would retail traders assume? Retail traders would assume that a double top is a sign of a reversal, right? A double top is a sign of a reversal. Or is this the M formation and all of that stuff? Or is resistance and all of that? So they might think that it is a sign of a reversal. Okay, they might think that it's a sign of a reversal. So what they do is, once this breaks, they'll expect a move like this. Right? They'll be expecting something like this. So what will they do? Once it gets here, once it gets into these areas, they'll sell it, stop loss above the double top, and they'll target lower prices. But smart money, okay, smart money knows this. Smart money knows that there's a pool of liquidity resting above those equal highs. So what will smart money do? They're going to force a move now. Okay, they're going to start placing buy orders in these areas. They'll place buy orders, they'll knock out, like they'll take out everyone that placed their stop loss above that high, and then they'll push price down. Okay, so what is actually the order block? Okay, and now the order block will be where the buying started from. Okay, where did the buy start from in order to do this manipulation? Now, why do we call it an order block actually? Now, it's like this. Now, this move to the upside was a forced move, right? This was forced by smart money. But when a buy will only profit when the market is moving up, right? But the market is moving down now. So now what's happening is smart money is now in a drawdown, right? The market makers are whoever that pushed this price to the upside is now in a drawdown because now they have their opened buy positions in these areas, but now the market is moving down. Okay, so what they do is now they do not use stop losses like us. Okay, their pockets are deep. So what they do is they will push price back up into that area where they earlier bought it from. So this is what we call a mitigation, mitigate out of their loss and then push price back down. Okay, so an order block will be this price level where the price level they used to buy it from. Now you might be wondering, okay, so we might have many levels, right? We might have many levels. So I'll show you how to spot the right level. Okay, I'll show you how to spot the right level at least 85% of the time. Okay, so we'll be always going into the higher time frame. So now first thing, now let me show you order blocks, breaker blocks, rejection blocks, all of that stuff. Okay, so let's see. Here we have a nice example.
Yeah.
See that this right here is simply what we call a rejection block. This is what we call a rejection block. So the closing price of the bullish candle or is the opening price of the bearish candle. This right here is what we call a rejection block. And remember, there's a simple rule to it. Okay, there's a simple rule to it. Let's say maybe there is a candle or a wick that has tapped into it like this. Okay, let's say we have a wick or something that has tapped into it like this. So we are not going to use this level anymore. Okay, we're only going to use fresh levels like this. Okay, levels like this. So now look at this. The opening price of the bullish candle is an order block, right? The last push up before the push down. So where did this price tap into? Right into this one.
Yeah.
Opening price or is the closing price of this one. Okay, so price tapped right into this. So the closing price of the closing price of this bullish candle is your order block or is the opening price of this one. And yeah, the opening price of the bearish candle can be your rejection block. Okay, so same thing. Look at this one, even this. Okay, even this is a point of interest. Even this one, even this one. All these areas are POIs, but we're not going to use all of them. Okay, we're only going to use the ones that has liquidity below it. So that's why we first talked about this one, right? That is why we first came into this example because now we know that there's a pool of liquidity resting in here, right? So first thing we do is like, we're not going to just directly just mark out a rejection block as an opening price and then wait until price gets there. No, first we spot the liquidity and only above that we look for a point of interest. Okay, I'll show you examples. See, like even in here, this one tapped right into it. Maybe there was some liquidity in here. Okay, so let me show you some clear examples. Yeah, now look at this one. This right here is what we call the order block. Okay, not the whole candle, not the whole candle like this, only the opening price of the bullish candle. Okay, the opening price of the bullish candle. This will be your order block. Okay, so we're not going to mark up boxes. No, we're only going to just draw a line, because I told you an order block is a specific price level. So this right here will be that line. Okay, the opening price. So now if you go to lower time frames, now that's why I told you it's the same thing. Order blocks, breaker blocks, rejection blocks, whatever it is the same thing. But once you switch time frames, you'll get a different view of it. Now see, the 4-hour order block is what on the 1 hour time frame it is a breaker block. Yeah, on the 1 hour time frame it is a breaker block. So you can even refine that one into this rejection block. See, so you can just go from time frame to time frame. So what
Sorry,
okay.
on the topic of rejection block, what defines, what makes, like, does he have to grab liquidity for it to
It
be?
doesn't have to grab liquidity. Okay, main thing is it has to have liquidity below it. Okay, it has to have liquidity below it. That's the main thing. Now remember, like, we're not going to use all of the rejection blocks. We're only going to use the ones that are in line with the current market direction. Okay, so once we go into ranges and all of that, let's talk about direction and all of that later. But yeah, we're only going to use the ones that are in line with the current market direction and has liquidity below it. Like for example, this one. Okay, we clearly have equal highs and all of that, right? Our smart money traders, so supply and demand traders, everyone will get trapped, right? Look at the supply. Let's look at that order block. Many are trying to sell it here with their stop loss above that high, but we sell from above it. Okay, so yeah, all the liquidity gets taken out right into this one. Yeah.
What qualifies this one now as the rejection block? Why?
Which one?
This.
Now it's like this. Yeah, now you saw how we refined it, right? Like we did not just directly chose this one.
Okay.
First, we looked into the higher time frames, 4-hour order block, refined into the 1 hour rejection block like this. A slight refinement. That's it. Okay, and also this is a strong high. Why is it a strong high? Liquidity grabbed, structure broken.
Yeah.
Okay, so yeah, we have a strong high. We have the higher time frame point of interest. That's our 4-hour rejection block. I'm sorry, 4-hour order block that is refined here. And most importantly, we have liquidity below it. And the final factor we take into consideration is timing. So timing is perfect. This is London Open. So this was February. So you can see if I set it to London time right at 8 a.m. Okay, so timing. We're going to focus on all of that. Okay, we're going to focus on timing. We're going to focus on strong highs and lows, high time frame POIs, and all of that. Okay, so yeah, that is a simple example. Let me show you some clear ones. Okay, mainly the rejection blocks because it's very important. Let's see some more. Yeah, look at this one. This was clean. Yeah, I'm only showing you rejection blocks. Okay, let's talk about structure, ranges, direction, and all of that later. Okay, now look at this. Yeah, if we go into the H1, and you'll also see that we're not going to use the 1 minute. Okay, let me just delete that. We're not going to use the 1 minute. These are the only time frames that we're going to use. Okay, now don't worry. Even while using this, we will have 2 to 5 pip stop losses only, nothing more than that. Okay, so I'll show you how to get this tight stop loss from the 1 hour and to the 4 hour itself, because you know how messy the lower time frames are, right? It's so much noise. Okay, so much noise. So yeah, like we're not the algorithm, right? We do not know how to deal with it like very precisely. So the best thing to do is we're going to focus on these time frames and we'll get sniper entries and you'll see all of that. Okay, I'll show you. So yeah, now what is this? A strong high, right? Why? Liquidity taken out and structure broken. Okay, like now in this market, of course, there is no no reason for you to buy, right? Because look at this one. The major breakout structure is what? Bearish.
Bearish, yeah.
Right? The major breakout structure is bearish. So when the major breakout structure is bearish, what are you going to focus on? Strong lows? No, you're going to focus on strong highs. Okay, because those are the ones that are in line with the direction. Okay, so now we know that major breakout structure bearish, counter trend also turns bearish. So then we call it a range expansion. Let's talk about that later. So this turns into a strong high. Okay, so on the strong high, remember, once a strong high is created, we always look into the higher time frames to see what our point of interest is. Okay, now look at this. On the strong high of the 1 hour, what do we have on the 4 hour? A rejection block. Okay, so now we have everything. We have everything we need. Strong high, high time frame point of interest, and most importantly, liquidity sitting below it. Can you see that? We have liquidity below it, a swing high, not just a random swing high. This was actually the previous day's high. Look at this. The previous day's high is liquid. So you know what's above previous day's high, right? A pool of buy stops. Okay, there will be buy stops resting above the previous day's high. So we can mark that one out like this. Okay,